Okay, so oh my gosh, we've got loads of comments. A common tactic that people use to get rid of bad information or bad figures is to bury it in the pre-Christmas news release. So it's out there just before Christmas and everybody breaks up for, best part of a week's worth of festive periods and it all becomes forgotten news. So in this video, I want to talk about what's happened to GDP just before we went into Christmas. I want to talk about the inflation figures that came out and how they are superficially dropping like a stone, but are they really? And basically ask the question, is all the data that we're being supplied in the mass media just completely made up and a load of hoop? And what effect is this having on the property market? And most importantly, what effect is it going to have as we go into Q1 2024? So good afternoon, everybody. It is the 27th of December. I hope everybody's had a fantastic Christmas. I've been off for the best part of a week, so apologies if you've missed my dulcet tones and the data analysis. I was missing everybody, so I thought I wanted to come back and do a couple of live streams this week to talk about everything that was happening pre-Christmas and since then, and we can start to look into 2024, which I think is going to be a fantastic year for property investing for various reasons. Before I do that, please, if you can hear me and see me, put something in the comments box, give me a thumbs up. We'll talk about subscribing to the channel in a little bit, just to make sure everything is running as it should be. And also put in the comments box, how has your break been so far? Are you still on holiday or are you back to work at the grindstone? Okay, good to get into the chat. So for those of you new to the channel, what we do on these live streams is look at data and try and understand what's going on behind the hood or underneath the hood to see what's going to happen as a forward-looking trend. Everything we talk about is trends. There's no point looking at month by month sort of data sets because they're meaningless. We need to understand what's going on in the trends. And what makes this quite difficult for us to understand is when the trends and the data change. So I'm flicking this up, which is the revisions or the new GDP for the last couple of years. And what happens, just if people didn't know this, we get headline GDP prints, okay, on a month-by-month basis and then a quarter-by-quarter basis, because calculating GDP, our gross domestic product, is quite a challenging thing. And so as more data sets come in, we have revisions to these GDP. And just before Christmas, we had quite a major revision come to the last couple of quarters. So I've got this in front of me now, okay. I want to start by sort of, if I just scroll up on this, you can see the columns. We've got GDP and GDP per head. So I want to talk about the GDP on the left, not the one on the right, okay. And that's the GDP on the right is the actual, so the nominal GDP, and then we have this implied deflator to give us a inflation adjusted GDP. So the GDP on the left is the one we care about. What I really care about is the GDP per head. But let's just start here. So at the bottom, we can see we now have in 2023, we have Q1 0.3, Q2 0, Q3 minus 0.1. So effectively, the last two full quarters have been 0 and minus 0.1. Now, the definition of a recession is two concurrent quarters with negative growth. So technically, we are just by a gnat's head. I'd be delighted to see the actual rounding that happened here to give us exactly 0, because it's unlikely to be exactly 0. If it was actually minus 0.00 whatever, which gives us a technical recession. However, this is not looking great, especially as this has been revised down. All these figures have been revised down. And if you remember, October's unrevised figures, the first sort of data release for GDP in October 2023 was minus 0.3. So we haven't seen November, and we're going to be asking, will Christmas have a much needed boost to give Q4 a positive growth figure as we go into 2024? We do not know this, but judging by walking around the Christmas shops the weekend before Christmas, the Christmas markets, there did not seem to be an awful lot of activity going on in the shops. And the only thing that I could see was pretty much all of the retailers with massive 50 to 70% sales a week before Christmas. That does not, to me, imply a huge amount of consumer spending going on. So will Christmas save recession? I would doubt it. Now, why do I highlight this and why do I think it's important? We've been talking for many weeks, if not months now, about are we going to recession and the implication that recession has on the UK property market and how it's cyclical, they're symbiotic. Because as we go into recession, it means people's perception of their wealth drops. People lose their jobs. I don't want to talk about unemployment today, but we go into a negative mindset, and therefore perception of wealth drops. Housing market follows suit. Housing market can cause us to go into a recession, of course. If the housing prices go down, again, our perception of wealth goes down. We spend less money. In a recession, we spend less money. People spend less money. Then everything goes cyclical, right? Companies have to charge less. Companies charge less. They lay more people off, and it all goes into a spiral. We've been talking about this for a while, and all of the headlines that have come out have talked about how resilient the housing market has been and how resilient the economy has been. And if we look at our politicians, our elected politicians, still the narrative that comes out of the mouths is that we are in a super strong position. Inflation is massively crashing way quicker than anybody thought it would. We're ahead of the curve there. The economy is strong and ready for growth. But the actual data now says last 2 quarters, 0 and -0.1. Now, I want to take you to the next column across. So the GDP per head, you see where it says note 3, GDP per head? Let's go into that, into 2022 and 2023. So if we look at the 7 readouts here per head, we've got 0.2, -0.2, -0.2, 0, 0.1, -0.1, -0.3. Okay, this is not pretty reading in terms of our GDP per head. Of course, we have population growth. We have a net migration input into the UK. So we're seeing this pretty much flat line of the economy with an increasing population, which means our GDP per head is going down. This is showing we are not productive as an economy. So I'm not going to go any more into the adjustments other than this, other than to say, right, this news came out like literally the day before Christmas. There are a few headlines about it, and nobody else really seems to have been talking about it since. And I think that's quite interesting because, you know, we've said for some time, it feels like we're going to be in a recession. It feels like we're in a recession right now. And I spoke last week or the week before about how I believe that we are in a consumer-facing recession. So again, when we look at the 2 main contributors to our GDP, there's 3. There's services, there's manufacturing, there's construction. Let's just take construction out of it for a moment, because the main 2 that we've got are manufacturing and services. We are way skewed, massively skewed to services, and services is very skewed to specific services that's been fueled by wage growth. And we just basically don't make anything in the UK anymore. We import pretty much everything. So manufacturing, is impacted hugely. But these services and the wage growth in the services, which makes up the main part of services, whatever they are, whether public services, financial services, it's wage growth, and that's coming up. So that's skewing things in terms of what's actually happening in our economy. So I've been saying for a while, it looks like we're in a consumer recession, and a consumer recession is directly going to link to the property market, because if we're struggling to afford stuff and buy stuff, that's one of the 3 main triggers that softens the property market. So we're going to come back and talk about that in a sec. Before I do, I would like, because I forgot the last couple of times, and therefore not a lot of people have subscribed. So I would like to ask you one favor. If you're watching for the first time, if you're watching for the 5th, 7th, 8th, 9th, 10th time and you haven't subscribed, please just watch the next 30 seconds. And at the end, please hit that subscribe button to help me get to the target of 5,000 within the first year of launching. And this has nothing to do with just helping the algorithm or that BS that everybody else says. There's a genuine reason for this. I'm going to tell you what it is now. For those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income-producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Okay, please do it now. Hit subscribe. Okay, so item number 1 I wanted to talk about was this revision to GDP. Jeremy Hunt has been there saying things are strong, yet it revises and we are not strong. Things are looking bad. The next thing I want to talk about is inflation. Okay, so last month we saw the second much higher drop in inflation than anybody expected. And I did a video a couple of weeks ago on that and whether are we actually now going to overshoot? Are things falling much more quickly than we thought they would do because of the supply side shock that caused the inflation in the first place is pretty much completely out of the control of our politicians, and the interest rate rises. So, surges in food prices, surges in utilities. The interest rate mechanism is not the thing that was necessarily going to control that. So when that supply shock feeds out the system, there is a theory that inflation could come down quickly and go into deflation, which is a possibility. It is a probability. The other probability is that the inflation figures are total BS, right? And actually, we do have much more systemic, sticky inflation, which is, if you look at left of arc, right of arc, okay? Left of arc, we're way overshooting, we're going to go into deflation. Right of arc is the figures are incorrect or inaccurate and don't reflect the actual position we're in. Because when you look at this basket of goods with CPI, they're not representative of how most people actually allocate their money, expenditure. And something that I talked about a while ago, I think it was August, September, was how the weightings for CPI had changed in 2023. So I just want to flick this up. This is on the latest CPI weightings report. Now, for those of you who don't follow this in quite as much detail as I do, the basket, if you like, of CPI goods, everything that goes in it has a weighting applied to it. Because don't forget, we are looking for CPI. We're not looking at absolute figures, absolute prices. We're looking at the rate of change. Inflation is the rate of change of something. So, if something is £1 and goes up to £2, even though it's only added £1 to it, the rate of change is massive. So that's going to, potentially need a higher weighting depending on what it is, versus something that somebody's spending £1,000 and it goes up to £1,100. It's a 10% increase, but it might be a lower weighting, if that makes sense, right? Anyway, I did a detailed piece of analysis a few months ago that talked about how the weightings had changed in 2023, at the beginning of 2023. And this is not an unusual thing, by the way. The weightings are reviewed regularly, but there was quite a detailed piece of writing on this, talking about how COVID had completely skewed everything. And so therefore, the weightings were being changed at the beginning of 2023 to more accurately reflect the expenditure, the average person's expenditure in 2021 and 2022. And I made quite a big dig at this, in that 21 and 22 is the post-COVID era where we were in massively cheap debt, interest rates were at 0.1%, and everybody was being given free money, and a lot of people being locked up at home and couldn't really do much. We go into 22 and 23, and I would argue, let me come off this for a sec, I would argue that people's lifestyles have completely changed. Now interest rates have gone from 0.1 to 5.25%. Okay, so affordability is now crunched, inflation was high, and therefore the balance that we are being given in the weightings for inflation right now is unrepresentative to how people are actually living their lives. So I did some analysis on this, and if anybody wants to go back and see that, this is from my channel. This is I streamed it 3 months ago, so that would be September. So go back if you want to see it. This piece of detailed analysis where I literally dived into these weightings tables and talked about this. But just to give an overview, okay, we can see here. I'm just going to pick this particular one, this line item here, which is housing, water, electricity, gas, and other fuels, which includes owner-occupier housing. So housing, right, includes owner-occupier housing, includes rents. And you can see the weighting in 2022 was 314. And this then dropped to 300, and it was revised up slightly from February to 303. But effectively what's happened is the weighting of housing and costs of housing was reduced beginning of this year. Whereas one would argue that actually, right, as interest rates have gone up, as rents have gone up, the weighting should actually be going up, because as a percentage of people's expenditure, that's going to be more. If we actually go down even further, and there is a special mention here to owner-occupier housing costs. You can see here, owner-occupier housing, it even says it. Owner-occupier housing has fallen by 14 points. Now, PPT is basically points per thousand. The basket is weighted in, everything split into thousandths. So it's fallen, OOH has fallen by 14 points between actuals and updates and actual rents for housing fell by 5. So rents have gone down, owner-occupiers housing costs have gone up. But it says, right, this is offset by electricity, which increased by 5, and natural gas that increased by 5. Now, here's the argument that I made all the way back in September, that I didn't go conspiracy, But I said, has this been done by purpose to meet the pledges of inflation falling by a certain amount? Because what they've done is they've reduced the weighting of housing costs and rental costs, and they increased the weighting of utilities, which if you look at last year, 2021 and 2022, is fair enough. But this year in 2023, housing costs have gone up hugely and utilities have come down because, of course, that spike was in 2022 for gas and electricity, so it's come down. So by increasing the weighting of gas and electricity, now that it's coming down, that is going to artificially accelerate or artificially make a bigger difference negatively. And because they have reduced the weighting in housing costs, because those housing costs are going up, it means that those increases are filtering into the CPI calculation less, if that makes sense. So both of these things working in the direction that they've been weighted in 2023 will contribute to CPI being lower than if it had stayed the weightings of 2022. I hope that makes sense, right? I don't know if I've explained that very well. Is this manipulation? And I'll ask you the question right now. Is this manipulation into the inflation data? Because let's face it, there is an agenda at play here, right? The government they need interest rates to come down. I would suggest they need interest rates to come down. Yes, people talk about inflation being good because it erodes debt. But if you look at the figures, with the debt servicing costs that the UK government has on their debt, plus the billions they are spending every single month covering the losses that the Bank of England are taking by selling their bonds at a loss due to effectively the gilt yields that have gone up so much, right? They need those interest rates to come down and those gilt yields to go down to be able to mitigate that loss, because we're talking about tens of billions of pounds worth of excess every year right now that's being spent on those two items. So not HMRC, UK government has a vested interest to reduce those interest rates as quickly as possible, to reduce those costs, which puts us in this really interesting position because we've seen this complete divergence between the Bank of England and what they're saying and this with what the markets are saying. And markets are pricing aggressive interest rate drops next year. Bank of England are still maintaining that they are going to be table mounting and they're not going to go anywhere rapidly. Now, I just want to disassociate with what's happening over the pond in the States. Totally different economic situation. Inflation is a completely different place. The economy is in a completely different place. So we cannot look at what the Fed is saying and start to take forward-looking advice at what the Fed is saying. We have to look at what's going with our data. And when we look into it, we still see high wage growth, right? We still see inflation, systemic internal inflation looking high. And when you look at the core inflation on the CPIH, it dropped, but only a little bit. So the main drop was on the CPI, which is when the housing costs are stripped out, right? CPI has seen those main drops. If you look at CPIH and more importantly, the core CPIH, it's not dropped that much. So when these weightings, and I believe looking at this, that in 2024, the weightings are going to revert to what they were, or revert to something that's going to be more representative. So I have a feeling when those ratings revert, we're going to see quite a change in CPIH. Not CPI. Remember, CPI has all those housing costs stripped out. Now, the mass media only talk about CPI. I've not seen a single mass media article, I don't think, talk about CPIH, because the headline figures that come out are CPI, which is inflation disregarding the housing costs, which is the main thing that most consumers spend, right? Either rent or mortgage. It's bizarre. So when we are filtering this through to the property market, I still see affordability being an issue as we go into 2024. However, knowing how markets work, if we do see interest rate falls next year, I think we'll see a big bounce in the market, because I believe sentiment has shifted in the mainstream media, that the mainstream media now saying interest rates are going to come down next year. They're going to come down more quickly. And indeed, I think that narrative is now seeing a thawing of the market, right? If we go over and have a look at Zoopla's last house price index, which again came out just before Christmas, the narrative is, even though house price, so year on year, dropped 1.1%, not a lot, okay, we have seen market sentiment improving with sales starting to go up. So new sales agreed running 17% higher than a year ago. Demand is also 19% higher as buyer sentiment improves. Now, I want to look at this graph. I don't really care about the purple stuff, which is 2022. So I think it's false comparing where we are now with where we were in December 22, because don't forget, we were still in post mini budget slump last year. I would say November, December saw the brunt of it, and then January we saw the pickup. So, this buyer demand versus last December and the number of sales agreed versus last December are less relevant. If we look at buyer demand versus 2019, we're still 11% below buyer demand in 2019. And 2019 was not a great year for the UK property market, right? Again, what they've done previously, Zoopla, is they have done 2022 or the last year, and then the other one is the 5-year trailing average. We've now cherry-picked probably the two, in terms of year on year. So December, the two worst years since the financial crisis. 2022 December was pretty bad. 2019 was also pretty bad. So we're still 11% buyer demand down. So it's hardly like we're flocking back. However, we have seen, interestingly, buyer demand down, but sales agreed up. Now, does that mean there's less buyers buying more? So there is a shift in sentiment that some people are like, we need to, we're going to come in now. That's interesting. There's still not a whole load of supply, which is interesting. We've got so much more stock on. Again, this is due to last year. However, the narrative with the Zoopla is not that things are going to reverse quickly. We're still going to see modest falls throughout 2024 because affordability is still the main player. And if we look at that sticky inflation, if we look at interest rates or what they are, it doesn't matter, really what people think. If interest rates are going to stay high all of next year, that affordability is not going to be unlocked. We're not all of a sudden going to be down at 2% interest rate. Yes, we've had multiple factors here that have propped the market up in 2023. We've had forbearance from the banks. We've had people switching from 25 to 30, 35, 40 year mortgages. And we've had massively strong wage growth. That wage growth looks to have been petering off. So I actually agree with Zoopla that we're still going to see modest price falls into 2024. However, if we do see interest rates come down, number one, the reason they'll come down is because we're in recession, right? So we need to save the economy. But I don't think that matters. I think mass market logic defies actual logic. And if we see interest rates come down, I think we'll see a pop in house prices next year in 2024. Not a massive one, but I think we'll see a pop in house prices. That will be bad news on a medium to long term, because I think we need to keep on correcting to get to a more healthy price to earnings ratio. If we don't see that continued correction for the next 2 years and we see a surge in house price in 2024, because interest rates start to come down, I think 2025 we could start to see some much bigger corrections come in. Anyway, that's my thoughts, team. I'd love to know what your thoughts are. Before I go on to questions, I've been saying for a while that we've had a lot of contradictory information and data, and it's been difficult to chart any particular trend. I do feel we're starting to see the picture crystallize now with the economy. I think it's actually trending the way we thought it was going to trend, which is into recession. It just seems to have taken a much longer time to get there and needed some revisions and actual data, accurate data to come in to show it, but it feels like we're now trending towards recession. The question is, how deep will it be and what impact will it have on the housing market? But if we go into recession, we've still got high interest rates. We've still got systemic inflation. It's going to be rock in a hard place. I think, government clearly wants interest rates to come down. Does the bank wants to keep them up because they can see? It's easy to be a YouTube commentator and say everybody on the MPC are a bunch of buffoons who have no idea what they're doing, right? Let's face it, all of the collective analysts who use various models are in there looking at what's going on. If the models are flawed, the forecasts are going to be flawed. But you can bet your bottom dollar that after all the flawed forecasts that missed the inflation go up in the first place, right, people are looking at the actual same data that we are looking at here and trying to interpret it in their way. I don't think they just sit there, the 9 of them, and go, this is what we're going to do this month, right? They're seeing the actual data, and they've got a team of extremely, highly paid analysts crunching this data for them. There is a real split occurring though, because I've seen a lot of very highly paid analysts saying interest rates need to come down now because we are going into recession quite quickly, right? And growth is falling off a cliff, and that's not good news for UK. It looks like we're pretty much in consumer-facing recession. Construction, we're not building anything new at the moment. Demand for aggregates, mining is down. This does not look good as we go into 2024. So there will be a rock in a hard place decision to make. Because if interest rates come down too soon, we could see, and that secondary wave inflation come in 2, 3, 4 years time, and bigger corrections is my personal view. So let's see what we've got in terms of questions. Sorry, we've got quite a lot. So let me see. By the way, give me a thumbs up if there was if that was useful looking at that data. Tomorrow, I'm going to do a live stream where I'm going to talk about where I think we should be investing if you're into property investment. So rather than just being a home buyer, if you're into property investment, where I think the opportunity is in 2024, where I would be putting my money, where I wouldn't be putting my money. So I'm going to do that tomorrow. Stafford says, smoke and mirrors from the government. Jeremy said things were on the up, didn't he? He did. Smoke and mirrors it is. Don't forget, we're going into election year as well. Stafford says, let me put this on. Question, does raising interest rates actually control inflation, given that the main sources of which are fuels, there are many guises that we import and had no control over? Yeah, so at the beginning, absolutely not. I think we've talked a lot about that inflation being supply shock rather than overheated economy. And so therefore interest rates are not the right mechanism probably, or, they don't really have any other mechanisms, like obvious ones. But now my feeling is what's happened is that supply shock inflation has come out. But we've got the path inflation in. So it's just, everything's going around circular because those prices had to go up. Affordability got difficult for people. Therefore, wages had to go up, and it's now going in this path to parcel. And, there's also the greed inflation narrative as well. I cannot believe companies have not taken advantage of greed inflation, regardless of what Hunter says. So, interest rates now probably are the thing that will help bring it down. When you look at the systemic sticky inflation, that probably is internal. But we have to trade that off against the recession, don't we? So yeah, good question. Richard, hey, just came back from my dog walk. Yeah, following with the bucket of water. It's horrible out there, isn't it? Merry Christmas, Sick Pal. Merry Christmas to you as well. Yeah. Dave says CPI isn't inflation; it's a consequence of inflation. Well, I mean, CPI is a read of inflation, isn't it? So inflation is all about our currency and credit. Yeah, we could probably dive into that and talk for another hour on it. So maybe a conversation for another day. Rich, I really don't believe a word of the data. If anybody really agrees that the house price have only dropped by 1.1% over the last year, then they really want their heads examined. Yeah, I totally agree with this as well, Richard. I think all of the indices are very misleading. They are averages. They are hedonic regression models. Certainly, if you know what you're doing, right, you go out onto the street, and I mean the price reductions are everywhere. Some super aggressive price reductions. And interestingly, look, I covered this with the ONS stuff a month or so ago. It actually says in the ONS house price index that their data excludes below market value transactions, which is, I don't know how the Halifax and Nationwide deal with something like that. But effectively, literally the ONS has said, if it doesn't fit our model, we're not going to include it. So if you've got all of these below market value transactions going on, they're just going to wipe them and not include them. So of course it's going to be tempered, because if there's a certain tolerance level of price change it's not going to read, of course it's going to be absolute bollocks, right? Come on, let's be honest here. So I don't believe any of them, to be honest, right? The only thing, it's a good question. The only thing that I know is you should be in control. If you're an investor, right, you are the person who are in control of buying property at a price that works for you. So it's why I say regularly. So obviously on this channel, on these live streams, we talk about trends, we talk about market data as a whole, we talk about, where things going to go trend wise. And we have to look at house price indices to see the trends. We have to look at ONS, we have to look at inflation, we have to look at interest rates. These are all trends. But the reality is on the shop floor, these the actual house price figures, from the Halifax, the Nationwide, are complete bobbins, completely irrelevant, right? Because when you're investing with certain mechanisms in mind, if you're looking to create, appreciation of an asset and cash flow or return, so cash flow, but really return on capital. So whatever you put in something, what are you going to get out on a monthly, annual basis? It's all about being able to force value appreciation recycle funds, and therefore it's about buying at the right price. So, averages just don't matter. It's just irrelevant, right? And don't forget, these are averages. It could mean, that there's a load of stuff that are massively below market value that are being excluded. And then there's a few high value things that are propping the whole thing up, right? We just don't, because nobody knows exactly how that data is working. But it's all vaguely irrelevant if you are doing this as a professional basis, right? So that's why I offer strategy course to help people. And by the way, if you want to know how to do it properly, white paper. So if you haven't downloaded the white paper yet, please do. If anybody is interested in how to invest in the current market with high interest rates and a falling market, this is going to show you the models that we use and how to do it. So robstewartglobal.com/white-paper, 30-minute read, very much worth it if you haven't read it already. I'll be talking more about this over the next couple of weeks or so. And I'm going to be doing some private trainings off YouTube as well, which I'll invite everybody to for free, which we'll go into probably first, second week of January if people are looking to get involved in property investing in 2024. Cool. What else we got in terms of questions? Down to Earth Rob. Good name. The BOE, Bank of England, will not risk dropping interest rates enough to trigger another housing boom. Yeah, and I do agree with this actually to a certain extent. I think the markets have overplayed their hand. In fact, I haven't actually looked what swap rates were before everything closed. I'm just going to have a quick look at what the swap rates were. But I think they've massively overswung, is my personal opinion. I might be completely wrong, right? We might be down at 3.5% by December 2024. I don't feel it when we look at the data. So let me just get this up and I'll share it in. So 5-year sorry, excuse my language. Look at that. So 5-year swap rate right now is 3.284. 3.284. Wow. 22nd of November. So that's a month before the markets closed. It was 4.1. It's dropped almost a full percentage in a month. That is insane. Look at that. That is massive for the 5-year. Wow. So 7-year, and then it goes back up again. Yeah. So as with markets are saying it's going to come down, but then go back up again long term. Funny, interesting. So there we go. I think the markets have overblown it. Hayes, what time's tomorrow? Tomorrow's live stream. Nick, you're literally a private client of mine. I'll see you on a week Tuesday. What about rumoured 50-year mortgages for first-time buyers as an election sweetener? I've not heard about that. Bornak, how do I pronounce that? Bornak? It's interesting. I wonder the impact that this extension of mortgages has had on the market, how much it's propped it up and how much of an issue it's going to be in 20 years' time. Because, of course, the theory with people taking a 35, 40-year mortgage is that they go, I'm going to take it, I'm going to spread it out now so I'm paying less per month. It's like if you go for car finance, right? You can buy a bigger car if you spread it out for longer. You're going to pay £500 a month for 2 years, gets you a car. £500 for 5 years gets you a much nicer car, but in 5 years' time, that car's going to be trashed, right? So I wonder how much, when people are going for 30, 35, 40-year mortgages, how much it's propped the market up and how much in 20 years' time it's going to affect people. Craptacular 82. I felt like we're in recession all year, but the GDP figures kept coming in positive. When I saw net migration at record levels, it kind of clicked. We've been, in a per capita. Exactly that, Craptacular. Yeah. The only thing we really care about is per capita, right? Because, if per capita is going down, then we are in recession. Doesn't, overall is kind of an irrelevant metric. Totally irrelevant metric. It's funny what we focus in on, right, as mainstream media and culturally, and we go, it's going up, so therefore everything must be great, even though per person we are getting not poorer, it's the wrong word for GDP, but we are less productive per person as a country, and I would say markedly so, and that looks as a trend to be accelerating away. So yeah, it clicked for me actually about 2 months ago. Cool. I'm going to end it. I'm going to end it there, team, because I've got my kids running around upstairs and I can hear them making a lot of noise. Just for tomorrow, Nick, I know you mentioned you're going to tune in. So as a little sort of intro as to what we're going to talk about tomorrow, I want to go what I think are the things to be investing in 2024. They will be some fairly niche strategies. Definitely not mainstream strategies that people are talking about. There's some things that I definitely wouldn't be doing, but there's some things that I'm starting to think about depending on where the market goes over the first 3 to 6 months. Because what we will see at some point is we will see nominal house prices probably bottom. I've always said that we'll probably see them bottom out, trough out, end of 2024. So as we're starting to do that, my thoughts as an investor are some strategies will start to change a little bit. There are some that I always do, right? I call them legacy wealth making strategies. But there are some higher cash flow, higher chunkier cash strategies that in 2024 I'll probably be putting my mind to. Nick, you'll know one of them we talked about, which is involving the mooted permitted development and splitting properties, houses into 2 flats. Of course, how you implement that and deploy that as a strategy very much depends on where you are and sort of the price per square foot values. So we'll have a chat about that and where my thoughts are with that. But I think that's very exciting. But yeah, momentum wise at the moment, everything I've been talking about in 2023 stands. Everything that I've talked about in terms of house prices still stands. I've said long and shallow. I've been saying it since the beginning of this year. Long and shallow correction into end of 2024, beginning of 2025, with real house prices correcting much more heavily than nominal house prices for a longer period of time. So houses continue to get cheaper in real terms, or property continues to get cheaper in real terms. So I don't see any change in that. I still don't see it diving off a cliff. It could always happen when we go into full-blown recession. We'll just have to see what happens. But I don't see it completely crashing unless we have a third-party black swan event, or something that's outside of our control. I'll also tomorrow talk about commercial property and why I think if interest rates drop, it could be the biggest opportunity of our generation if we're into commercial property over the next year to 18 months. So we'll talk about that tomorrow. So in the meantime, I look forward to seeing everybody tomorrow, and hope you are enjoying, as I said, that weird period between Christmas and New Year before we hit the ground running next week. All right, I'll see you tomorrow. Hope you have a great one.